That's still your favorite trade.
I think it's the most important trade. Yeah.
I know it's the most important. I feel like that's legit. But is it?
I think there's a bigger upside in the owning financials right now. Because financials are benefiting from AI.
Okay.
So they're the second order beneficiaries. Plus, they're getting the green light to build on the blockchain, which could really make JP Morgan and Goldman's business models so much more profitable and change their multiples, expand them. So I think, yes, I'm still bullish on AI, but I actually think the financials are really one of the legs that drive us the next 12 to 24 months.
Oh, interesting. No matter what the Fed does from here, I mean, does the rate picture matter for the bank stocks?
It does, because it helps. It provides the liquidity to sort of liquefy housing and corporate lending and bring spreads down.
Now, what he means by second-order beneficiaries is important. When a new technology trend takes off, there are the obvious winners. In this case, artificial intelligence hardware and software. But then there are the less obvious winners, the companies that leverage that technology to improve their own businesses. Banks, brokers, insurers, and payment networks are all building with artificial intelligence and blockchain. They are making their operations leaner, smarter, and more efficient. That means better profitability and more durable growth.
But I think the financial sector has produced visible earnings growth for a long time through these cycles, and they are trading like cyclical stocks. JP Morgan and Goldman should maybe have tech multiples, and so I think there's upside for financials.
I mean,
Tom Lee also pointed out something very interesting. Earnings growth is already being delivered by financial companies, but the stock market is not rewarding them with expanding multiples. In other words, profits are going up, but valuations are not keeping pace. That disconnect, in his view, is what creates the opportunity. He compared it to fintech during its earlier years, where adoption was accelerating, but Wall Street was slow to re-rate the sector. He even mentioned companies like JP Morgan and Goldman Sachs as examples. These are some of the biggest financial players in the world. And with their wide moats and business power, they should be able to benefit greatly from the advancements in both artificial intelligence and blockchain technology. Margins will expand, revenue will go up, and it's safe to assume that new services will be invented. For me personally, this really resonated. I was already pretty heavy in Visa and MasterCard, which are essentially the toll booths of the global payment system. I was shifting some positions around recently, which makes the entry price seem much higher than my original buys. Every digital transaction passes through them. I made huge returns on Robinhood earlier this year and was looking for another financial powerhouse to add to my portfolio. After hearing Tom Lee's conviction, I decided to add JP Morgan to my portfolio. This company had been on my watch list for a very long time, and in my opinion, the company is exceptional. It has a wide moat, consistently high performance, and an incredible management team that has proven itself in both good times and bad. I believe a good summary of Tom Lee's story is that yes, the big technology companies will likely continue higher. They are too strong to bet against, but I think Tom Lee is right that the next leg of market leadership will include financials. It will not exclusively be financial companies, but they will benefit greatly from the advancements happening right now. These companies are integrating artificial intelligence, benefiting from blockchain, and positioned to ride the long-term growth in digital payments. And that is why I am very excited about this sector. So let's cover why I've decided to add JP Morgan Chase. This is not only the largest bank in the United States, but also one of the most globally diversified financial institutions on the planet. When people think about safety in banking, JP Morgan often comes to mind. That reputation comes from decades of strong execution and what the company calls its fortress balance sheet. They hold one of the highest capital ratios in the industry, which means they are well protected against financial shocks. Fundamentally, JP Morgan is a revenue machine. Their consumer banking division touches tens of millions of households through checking accounts, mortgages, and credit cards. At the same time, their investment banking division is consistently number one or number two worldwide, advising on mergers, underwriting securities, and trading across global markets. This mix of businesses allows them to generate stable profits in almost any environment. Over the past decade, JP Morgan has grown revenue and earnings steadily through low interest rates, high interest rates, recessions, and bull markets. That consistency is part of why investors trust the company so much. And from a shareholder perspective, they have also rewarded long-term holders with both dividends and buybacks. Now, connecting this back to Tom Lee's thesis, JP Morgan is exactly the type of company he means when he says financials are second-order beneficiaries. Artificial intelligence is already being integrated into fraud detection, credit risk analysis, and customer service. Blockchain is being used to streamline settlements and payments. All of this lowers costs and boosts margins. Yet, despite these advantages, the valuation multiple for JP Morgan remains much lower than that of high-flying technology names. That sets up a powerful scenario. As earnings continue to grow and investors eventually recognize the role of artificial intelligence in finance, we could see both multiple expansion and new all-time highs. The stock has been trading near record levels, and a breakout seems very possible in the next year or two. Let us also not overlook dividends. JP Morgan pays one of the most attractive dividends among the large banks, and they have increased that payout consistently. For investors, that means you are not just waiting for capital appreciation, you are getting paid while you wait. And when the company buys back shares, that further enhances long-term returns.